Warren Buffett says he pays a lower tax rate than his secretary. Elon Musk built a trillion-dollar empire and bragged about paying almost nothing in federal income taxes some years. Jeff Bezos, at one point the world's richest person, paid zero federal income tax in multiple years, while ordinary Americans handed over a quarter or more of their earnings. And this isn't a glitch in the system. It isn't an accident or a loophole that's about to close. This is the system working exactly as designed. The tax code isn't broken, it's rigged. And the greatest magic trick in modern capitalism is convincing ordinary people that billionaires pay their fair share while building an invisible infrastructure that lets the ultra-wealthy avoid what the middle class considers inevitable. If you understand how this machine works, you understand why the rich get richer while everyone else watches their paycheck shrink. Let's follow the money. The first rule of billionaire tax avoidance isn't complicated. It's so simple that most people miss it entirely. Billionaires don't have income, they have assets. A billionaire's wealth sits in stocks, real estate, and companies. These assets grow in value, but that growth isn't taxed until it's sold. So a CEO with $10 billion in company stock doesn't owe taxes on those $10 billion as long as the stock stays in their name. If it grows to $11 billion, that additional billion is completely tax-free. Forever, unless they sell. This is called unrealized gains, and it's the cornerstone of billionaire wealth protection. An ordinary worker gets paid $50,000 a year and owes taxes on it immediately. That $50,000 is realized income the moment it hits their bank account. But a billionaire whose portfolio grows by $50 million in the same year owes nothing. The playing field isn't just uneven, it's designed in opposite directions. Most ultra-wealthy people understand this deeply. They structure their lives around never selling. They borrow against their assets instead. A billionaire wants cash. They don't liquidate stock and trigger capital gains taxes. They take a loan from a bank, using their $1 billion in stocks as collateral. They get the money they need, pay interest at low rates, and the stock keeps growing tax-free. If they die before repaying the loan, their heirs inherit the stock at a stepped-up basis, which is another way of saying the inherited stocks are immediately wiped clean of all capital gains taxes. It's as if the appreciation that happened over decades never happened at all. For ordinary people, an inheritance of cash is taxed as income. For billionaires, an inheritance of appreciated assets is a tax miracle. The step-up basis alone costs the government hundreds of billions every year. It's a wealth transfer mechanism disguised as tax policy. Then there's the charitable donation strategy. Billionaires are famous for their philanthropy. They create foundations, donate to causes, and get all the credit for generosity. What's less visible is that these donations come with massive tax deductions. When a billionaire donates appreciated stock to a charity, they get a tax deduction for the full market value of that stock. But they don't have to pay capital gains tax on the appreciation, so they've essentially converted private wealth into a charitable donation while avoiding the tax entirely. They get the moral credit, the tax break, and the control often remains in their hands through a donor-advised fund. This isn't illegal, it's expected. Billionaires donate stock that's about to decline in value and deduct the peak price. They donate appreciated assets and avoid capital gains. They set up charitable vehicles that flow money through their own family members and closest associates. The charity itself might do genuine good, but it's also a perfect tax shelter. The middle class donates to charities too, but they can only deduct donations if they itemize, and most itemize less than the standard deduction anyway. So their generosity gets no tax benefit. The billionaire's generosity is subsidized by the tax code. Capital gains taxes are another frontier of the billionaire advantage. When you sell an asset you've held for more than a year, it's taxed at the long-term capital gains rate. For most billionaires, this rate is 15%. For ordinary people in higher income brackets, the ordinary income tax rate reaches 37%. So a billionaire selling stock pays a lower tax rate than a surgeon or lawyer earning high income. The logic is supposedly that capital gains should be taxed lightly to encourage investment. But billionaires with billions already invested don't need encouragement. They pay less tax precisely because they're already wealthy. A young person working their first job at $50,000 a year pays a higher tax rate on that $50,000 than a billionaire pays on $50 million. The system calls this efficiency. It's actually designed backwards. Then there are the corporate tax strategies that make individual taxes look simple. When billionaires own companies, those companies can deduct everything. They can deduct salaries, yes, but they can also deduct stock options for executives, which reduces taxable income while transferring wealth to the top. They can deduct research and development, lobbying expenses, executive retreats disguised as conferences, and corporate jets. The CEO flies on a company jet and deducts it as a business expense. An ordinary person buys a car and can't deduct the fuel. Corporations that make billions in profit shift that profit to tax havens. They create subsidiaries in Ireland or the Caribbean, shift intellectual property there, and pay royalties back home that reduce taxable income in the United States. It's called transfer pricing, and it's not even technically illegal. Every major tech company does it. Apple famously kept billions offshore to avoid paying US taxes. Google does the same. Amazon was structured so cleverly that it paid essentially zero federal corporate tax for years while making massive profits. These aren't exceptions, they're the strategy. The carried interest loophole is where private equity and hedge fund managers become billionaires while barely selling anything. When a fund manager invests client money and profits, they typically take 20% of the gains. This is called carried interest. Remarkably, the tax code treats carried interest not as income, but as a capital gain. This means fund managers pay 15% tax on earnings that should arguably be taxed as ordinary income at rates up to 37%. A hedge fund manager earning $100 million a year might pay taxes as though it's investment income. An emergency room doctor earning $200,000 pays a far higher rate. The gap is enormous and by design. Every year, wealthy individuals and their accountants find new ways to restructure income as capital gains. The depreciation strategy is another masterclass in how the tax code favors assets over work. When a billionaire buys a building or a plane, they can claim depreciation deductions even though the asset might be appreciating in real value. A skyscraper depreciates on paper, generating tax deductions but appreciates in reality. A real estate developer buys a property for $100 million, claims $50 million in depreciation over 10 years, reduces taxable income by $50 million, then sells it for $150 million. They've paid little tax on the gain because of the depreciation they already deducted. This happens year after year across thousands of properties. The strategy is so common that entire fortunes are built on paper losses that mask real gains. Meanwhile, ordinary workers face withholding. The government takes taxes directly from paychecks before workers see a dime. There's no ambiguity, no strategy, no opportunity to structure income differently. A school teacher earning $70,000 has no choice about the timing or character of that income. It's taxed immediately at ordinary rates, but a billionaire's financial advisors spend millions planning how to characterize, defer, and ultimately minimize taxation. The difference isn't talent or hard work, it's access to complexity. When you're poor, the tax code is simple and harsh. When you're rich, it's intricate and generous. Stock buybacks are another sleight of hand. When a company buys back its own stock, it reduces share count while increasing the value of remaining shares. Executive stock options suddenly become more valuable without anyone actually earning anything new. The company gets a tax deduction for interest paid on money borrowed to do the buyback, but shareholders get capital gains from the appreciation, A worker's wages are taxed. A shareholder's gains are taxed at half the rate. This mechanism alone transfers trillions upward over time. During the pandemic, companies received government relief money and used it for buybacks instead of raising wages. Workers stayed underpaid, shareholders got richer, and the tax code blessed it all. The generational transfer is the ultimate prize. When a billionaire dies, their heirs get the entire estate minus only a small federal tax, because exemptions are now so high that nearly no billionaire's estate actually pays tax. The exemption is over $13 million per person and rising. A billionaire with a $100 billion estate passes it to heirs who get the step-up basis on everything. The appreciation that took decades is erased. Dynasties begin not with intelligence or innovation in the next generation, but with access to an accounting system that lets them inherit unlimited wealth tax-free. An ordinary person's life insurance goes to heirs, who must pay income tax on the gain. A billionaire's empire goes to heirs untouched. The cruelest part is how the middle class subsidizes this. Middle-class taxes pay for roads, schools, military and infrastructure. But the people who benefit most from that infrastructure, the ultra-wealthy whose fortunes depend on stable systems, pay the lowest rates. A trucking company needs roads and pays fuel taxes. But the billionaire who owns the trucking company pays capital gains rates on profits generated by those same roads. A tech executive benefits from a university system funded by middle-class taxes, but pays lower tax rates on the wealth that education generated. The system has become inverted. Those who can least afford to pay more have become the ones paying more. The tragedy is that it's all defensible within the rules. Accountants and lawyers aren't breaking law. They're reading it, exploiting it, and staying within it. The billionaire isn't cheating. The system is cheating on the billionaire's behalf. And the system persists because those who benefit from it also write it. Wealthy donors influence politicians who shape the tax code. The tax code protects wealthy donors. And so the machinery grinds on year after year, transferring wealth upward while wages stagnate and the middle class watches their purchasing power erode. The ordinary person sees a billionaire and thinks either criminal genius or lucky break. Neither is true. It's simpler and more damning than that. It's a choice encoded in law. A choice that says unrealized gains aren't income, that borrowed money isn't taxable, that paper losses offset real gains, that assets are treated better than wages, and that those with the resources to hire armies of accountants deserve to pay less than those who cannot. This isn't capitalism. It's not meritocracy. It's a rigged game with rules written by the winners. If this gave you a new perspective, hit subscribe. History has the answers, and the tax code is history too.